Since you most likely work hard for your money, you must also be smart with money to hold on to it and put it to work so that it helps you achieve your financial goals. It can be overwhelming, and it's easy to think you aren't doing what you're supposed to. Chances are, however, that you're doing better with money than you realize. Take a look at the accomplishments below, and they are accomplishments to get some perspective on your finances. Today, I'm going to show you 15 signs that you are smart with money. Before the start of the video, make sure to leave a like, and if you want to see more content, subscribe to the channel. Let's get started. Number 15. You are aware of what you know and don't know. People who are smart with their money don't act as if they know everything. They take advice from experts. This could entail locating a reputable financial advisor. Alternatively, they could seek assistance from business journals or other sources. As a result, they gain expertise on topics that previously confused them. Number 14. You do not replace it if it's still in use. People that are smart with their money only spend it when necessary. They don't change a TV if their current one works just fine. The same actions go into cars, sporting equipment, and tech, even though it might be great to treat yourself to something new now and again. Smart money people demonstrate that they are never on a never-ending chase for the latest and greatest. They've accepted that upgrades and enhanced versions of products will always be available. Number 13. You have set a budget. Even while most adults claim to have a budget, few of them keep to it. People who are smart with money don't just say they have a budget, they follow it. Consequently, they are reminded of their ultimate objectives. This allows them to stay on track when the temptation to spend arises. It's critical to understand how much money you make each month and where it all goes. Number 12. You're thinking about the end. Indeed, a quick spend on a card upgrade can be enticing. People that are smart with money, on the other hand, have a clear end objective in mind. It could be the ability to retire at a specific age. It could also be that you want to be financially independent of your boss. If you are continually looking ahead to your main goals rather than succumbing to impulse purchases, you are displaying signs of being financially savvy. Number 11. You use the money you have to buy luxuries. It is preferable to spend money rather than money you do not have. Those that are smart with their money ensure that they are not living a luxurious lifestyle on credit. It is not only expensive, it's also a risky game to play. Before you know it, you'll be sitting on the couch you bought on credit and couldn't afford, admiring the view from the sidewalk. Short-term loans have the highest interest rates. The wise investor is aware of this and avoids it. Number 10. You shop for necessities with a plan in mind. Everyone requires a to-do list. You have a plan if you have a list, and if you don't plan, you intend to fail. It's usually a good idea to shop for a home or a business with a budget in mind. It's easy to get caught up in the frenzy of shopping in online and physical stores. They're made specifically to cause this. With a list in mind, you won't end up shopping armfuls of not-essentials or nothing at all. Number 9. You are covered with insurance. Accidents are unavoidable. People who are smart with money, on the other hand, are unconcerned about this. They enjoy peace of mind because of their monthly donations to short-term insurance. Their personal and business property is already covered by insurance against loss or damage. They will be covered in case of a loss due to unforeseen events. It is one method of projecting financial longevity into the future, rather than needing to have a large emergency fund at hand. Number 8. You can pay your bills each month. A 2015 study from the Pew Charitable Trusts found that 55% of Americans either break even or spend more than they make each month. If you can afford your housing and utilities, basic food, transportation to work, student loan payments, and any other important recurring needs every month without going into debt, you're off to a good start. Once you have your immediate needs covered, you can turn your mind and your money to growing your wealth. Number 7. You regularly save, even if it's only a little. You might judge your success or failure by the size of your savings, but the habit of saving itself is more important to your long-term success than the average amount you have squirreled away. You're doing better than you might think if, quote, you've developed a savings habit, Fox said. People who save regularly, a set percentage from every payment received, whether from salary, freelance work, side gig, or yard sale, are quietly developing good financial habits that will help them achieve the goals they set and weather unexpected hard times. Number 6. You could survive a few turbulent months. One of the scariest financial statistics involves the millions of Americans who couldn't survive even a modest financial speed bump. Therefore, you're doing better than you might think if, quote, you have an emergency fund that could cover 6 to 9 months of basic living expenses, said Fox. The vast majority of Americans can't even cover a $500 expense. The reality is that even this little will go a long way towards the inevitable unexpected car repair, doctor's bill, or other expense. Number 5. You don't carry credit card debt. If you feel like you're struggling, you might be doing better than you think if you don't carry a balance on your credit cards. By paying your statement in full every month, you avoid financial charges and the trap of revolving debt. The benefits of not carrying a balance are bigger than avoiding interest charges. It speaks to a healthy financial mentality. Charging no more than you are sure to pay off in full and on time each month promotes living within your means, said Fox. Number 4. Your checking account is never short. Overdraft fees and returned check fees are a drain on your bank account. But like credit card finance charges, the bigger problem is the shaky financial foundation that they spring from. If none of that applies to you, that's something to be proud of. Quote, one sign that you are doing well financially is when you never overdraw your checking account, said Olivia Tan, a Florida-based personal finance coach and the co-founder of CocoFacts. Even if you have overdraft protection with your checking account, you still prefer to keep a cushion in your account rather than relying on the protection, and you, positively, never bounce a check. Number 3. Prepare for the future. Set savings goals. Saving money for your future is crucial. If you don't set savings goals and steadily work towards them, you will have to rely on credit when times get tough. You might even need to work through your retirement years to supplement your small government pension. Entering retirement may also be delayed or impossible if you're in debt, because you need enough money to make all of your payments. Start saving regularly using a tax-free savings account or an RRSP, or both. Plan for your retirement. Figure out how much money you will need to retire comfortably, and then start saving. This money also makes a great rainy day fund if you lose your job or suffer another unexpected financial setback. Make sure you have enough insurance. Accidents happen. 1 in 4 people is hurt on the job. Natural disasters can easily cause thousands of dollars in damage to your home. Make sure you have enough insurance for the place you live and the lifestyle you lead. Write a will and decide who will get your assets and/or take care of your children when you die. This lets you decide who benefits from all of your hard work. Number 2. Start saving early. But it's never too late to start. Due to the magic of compound interest, even when the rates are low, someone who starts to save for their retirement early doesn't have to save as much as someone who starts saving later in life. If 2 people decide to save for retirement, but one starts at 21 and the other at 31, the 21-year-old can have $100 per month until they're 65 and accumulate $253,000 for their retirement, assuming a 6% annual rate of return. The person who starts at 31, on the other hand, will have to save $190 per month to have the same amount by age 65. So, the second person would have to pay almost twice as much per month to make up for waiting 10 years. It's never too late to begin saving. The sooner you start, the better off you will be. Number 1. Sleep on it. Don't be hasty with big financial decisions. There are no major financial decisions or major purchases that need to be made on the spot. Being pressured into making a hasty financial decision is one of the warning signs that the deal might not be as good as it seems. All worthwhile opportunities will be there another day if you're patient. It is better to wait and learn a cheap lesson than hastily rush into something and learn an expensive lesson. When you take the time to sleep on big decisions, you have time to consider alternatives, evaluate whether you need to do this, and probably get some other opinions or information. These are wise things to do every time you make a big decision, but especially financial decisions. Thanks for watching, guys. If you enjoyed this video, smash that like button, subscribe to the channel, and turn on post notifications to see more of our future videos. With that said, keep enjoying our videos, and I'll see you in the next video.